All right, let's get right into it. Today, we're going to uncover a pretty terrifying connection, one that links these quiet policy meetings happening in Tokyo directly to your tech-heavy stock portfolio. You're going to want to see this. So picture this. You wake up, you grab your coffee, check your phone, and boom, the Nasdaq has just tanked 5%. What's your first thought? It's got to be, okay, which big tech company just dropped a terrible earnings report? But what if the reason had absolutely nothing to do with Silicon Valley?
Because you know what? It wasn't a product flop, it wasn't a missed sales target, it wasn't some CEO scandal. Nope. All the usual suspects, they have alibis. The real culprit is this. Well, it's this hidden financial engine that's quietly moving trillions of dollars all around the globe.
That's right. The thing that kicked off that 5% nosedive in your favorite US tech stocks actually started thousands of miles away in the foreign exchange market. Today, we're going to pull back the curtain and show you exactly how this happens. So that brings us to Section 1, the Tokyo Shockwave. We're about to explore the invisible engine that powers so much of the global markets, right up until the day it violently slams into reverse. At the very heart of the story is something called the carry trade. Now, I know it sounds super complex, but the idea is actually incredibly simple. It's basically financial arbitrage. You borrow money where it's practically free, and then you invest it where you can get a much, much higher return. And for decades, the cheapest place on Earth to borrow money has been Japan. Okay, so let's actually decode this carry trade. We're going to break down the engine room of this whole global strategy, see how it really works, and where all that money is actually going. So here's the playbook. It's pretty straightforward. First, a huge hedge fund or a big investor borrows a massive amount of Japanese yen at almost 0% interest. Can't beat that, right? Second, they immediately swap all those yen for US dollars. And third, they take all those dollars and just pour them into assets that promise big returns. Think booming US tech stocks. The profit they make comes from that spread, the difference between their tiny borrowing cost and their huge investment returns. And this chart shows you exactly why it works. For years and years, the Bank of Japan has kept its interest rates pinned down near zero to try and get its economy going. Meanwhile, over in the US, the Federal Reserve has had much higher rates. Well, that gap, that interest rate differential, is the fuel for the entire carry trade. It's like a giant flashing neon sign for global capital that's just screaming, hey, free money over here. But what happens when that free money all of a sudden isn't free anymore? Well, that's when we get to the really dangerous part of our story, what's called the Great Unwinding. It's when this incredibly profitable trade suddenly and violently goes into reverse. And when this unwinding happens, the numbers are they're staggering. In one recent event, over just a few weeks, $6.4 trillion were just wiped from global markets. This isn't some small correction, it's a full-blown financial earthquake.
And listen, this isn't just a theory. This was a real event. The financial media even dubbed it the Great Unwinding. It's what happened when hundreds of billions of dollars in these carry trades were all forced to reverse course at the exact same time.
So what was the trigger for all this chaos? A tiny, tiny move. The Bank of Japan just nudged its policy rate up slightly above zero. That was it. But that one little move meant the entire premise of the trade, borrowing for free, was gone. The interest rate gap slammed shut, and traders had to unwind everything immediately, creating a massive stampede for the exits. So this brings us all the way back to our original question. How does this chaos in Tokyo make your tech stocks, all the way over in the US, bleed red? Let's connect those final dots. Okay, so here's the absolute crucial point. To close out the trade, those funds needed to get their hands on Japanese yen to pay back those loans. But to get yen, they first had to sell the US assets they'd bought. And what do you sell when you need cash, like right now? You sell your most liquid, most popular holdings, which for the better part of a decade has been US technology stocks. And this is where a hidden connection gets revealed. Normally, you'd think the US and Japanese markets kind of do their own thing. But during an unwind, all of a sudden, they march in perfect lockstep, because frantic selling in one market forces selling in the other, as everyone just scrambles to cover their currency bets. And here is the brutal truth of it all. Leverage. See, traders aren't just using their own money, they're borrowing to make much, much bigger bets. That means a tiny 1% move in their favor can be amplified into a huge profit. But leverage, as we know, is a double-edged sword. When the trade goes against you, that exact same amplification creates catastrophic losses, forcing you to sell everything you own. That's an event called a forced liquidation.
Now, this isn't just a history lesson. With global debt where it is and central bank policies at a major crossroads, a lot of analysts are looking at 2026 as a potential flashpoint. Understanding this mechanism is absolutely critical for navigating whatever comes next. And that's the key takeaway here. The yen carry trade isn't some one-off event. It's a permanent feature of the market. It represents a systemic risk, a vulnerability that's literally baked into the entire global system. It's really not a question of if it will unwind again, but when.
So what are the signals you should be watching for? Well, first, any hint of a policy shift from the Bank of Japan. Second, keep an eye out for any sudden sharp strengthening of the yen against the dollar. Third, a spike in the VIX, that's the market's fear gauge, is a big red flag. And finally, an inverted yield curve, which is a rare bond market signal that often screams economic stress is coming, could be the final trigger.
And that leaves us with one final, pretty unsettling question. We spend all our time focused on earnings reports and domestic policy. But is it possible the biggest threat to your portfolio is silently building in the currency markets, an entire ocean away? Thanks for watching.